Very warm welcome to all of the participants in this room as well. It's a fairly short presentation, so we won't take a lot of time to just go through it. The advantage is that we should have ample time for Q&A as well as we start off. With that, let's get started off for this particular conversation, which is unlocking cash flows. And that ends up being a very sticky and a tricky topic for a lot of founders, for a lot of companies in itself. We're going to start off rather unconventionally in itself, which is speaking about things that aren't usually spoken about. And you always hear a certain narrative that is being pushed out in the market through the media as well. But I wanted to start off by debunking some myths, because they are critical for founders and for companies to be able to unlock cash flows in the first place. RBF actually comes much later. And these are the three subheadings in itself, which is choosing one's own growth path, debunking a myth that capital is either or, it's not, and most importantly, building for the long game in itself. There are always pressures to not do that. There's always pressures for optimization in itself, but one has to sort of focus on going and building for the long term. So 3 sub-bullet points within each. I'll just go through them over the next 5-7 minutes. Think of this as an amalgamation of my experience being an investor, being an entrepreneur in a large corporate, and as an entrepreneur as well, as to common mistakes that companies and founders end up making as well, which is why they start ending up having issues with cash flows. There's a common belief that the ultimate future of a company has to be an IPO and M&A, and I'm here to debunk that myth. It is not. There are enough and more companies that go on much longer. Obviously, when we are working with investors, equity investors, with VCs, private equity guys, ultimately they would want an exit out of an IPO and M&A, but you need not necessarily switch into that mind space all on day zero in itself. You can very well build a large business in itself, and then at the right point in time, choose how you want to figure out what the future of your company is going to be. Today's success is measured more by equity funding rounds. You always hear this in the media. If you've done well, that is a corollary of an equity funding round. That is not the case. Even if you build a large profitable business in itself, that is a great way of building a business in itself. What I'm going to speak about later on in this overall presentation is that you need to have phases. There are phases of growth spurts, which are fueled by another pool of capital, and there are phases of what one would call slow growth in itself, but aim towards profitability, for which other pools of capital in itself start becoming more and more relevant and useful. In that, you need to figure out what is your strategy as a company. Success is not determined by equity funding rounds only, which is the ongoing media narrative. You have to think of your business as phases. There are phases in which even doing a slow yet moving towards profitable growth is a great way of building a business, and then you complement that with equity rounds in itself. The second part is speaking about capital not being either or, where there are different pools of capital, and you have to think about the pros and cons of each pool of capital. Smart companies, especially the ones that become larger, always keep on complementing different pools of capital around their core business in itself, which allows them to grow much bigger, much larger over a period of time. Last but not the least, again, something that is not spoken about is that you need to build for the long game. In itself, if you were to think about it, equity sort of constrains you in some form, shape, or manner, forcing you to think about the next milestone, which is going to be an equity fundraise. There is nothing wrong with that. In fact, a lot of businesses have done that, and that's a great way of building your own business as well. But you also need to think about how do you balance your ownership with some of these growth requirements. There isn't exactly a one-size-fits-all. Nothing beats sustainable revenue and profits. Ultimately, if you are going to be a large company that has raised equity rounds and you go for that IPO, M&A, whatever that exit opportunity be, you will still be valued against those revenues and profits that you are making, apart from your core IP in itself. So options only come up if you are alive. A lot of businesses, a lot of founders that I see end up making the same rookie mistake over and over again. They end up diluting way too much, way too early. And then later on, they don't preserve their ownership by utilizing other forms of capital in itself such that they can grow. Now, the reason why we're highlighting this is again not an either or argument. This is an argument to help you understand that when you combine equity with other forms of financing, you get that powerful, explosive mix that allows you to scale up much further. It allows you to build a much larger business. More importantly, it allows you to unlock your cash flows at different phases in different use cases as well. Just a quick comparison, switching gears into the different pools of capital that are available for businesses at this point in time. Obviously, Club speaks about revenue-based financing. So we'll park that for a moment at this point in time. We'll speak more about some of the other forms of capital, which are well-known, prevalent, but we should still speak about them for the sake of completeness. The first one, most important one, is venture capital and private equity. This has been on in the India market for the last 30 years or so. And so you've seen a lot of large companies built on the back of this particular pool of capital. However, when it comes to consumer businesses, we are only seeing that phase of venture capital and private equity of late. It is a very new phenomenon. A lot of it was coming in on the back of COVID, when the consumption shifted to more of an offline shift consumption shifted to online. But now we're absolutely seeing a shift back into omni-channel. And this is where equity in itself ends up being a great option in itself. We always recommend to all of our founders in that you should raise bank debt if you have the ability to do so. Bank debt is notoriously hard to crack, largely because it takes a long time. And then it always asks for all sorts of bells and whistles. There is loan against property, loan against equity. There is cash collateral that you end up giving, which is not exactly ideal for a growing business because, again, you're locking up your cash flows trying to get that line in itself. However, we always recommend that you should have some sort of a bank line in itself because that is a longer term partnership that you are building. Typical turnaround times for bank debt is very, very long. NBFCs, on the other hand, which are doing SME financing, have a much shorter turnaround time in itself. Yet, it does not end up being the end-all, be-all solution for a lot of businesses. Venture debt has come off vogue, and that is a great way for venture-backed companies to raise debt capital. It is applicable only for a few set of businesses that have raised that have raised venture capital and have scaled up as well. Because ultimately venture debt is trying to make returns off of the warrants of the business in itself. It is dilutive in nature, but it's a great option for you to raise capital. We always say this, that if you were to apply apples to oranges, the warrants for a unicorn in itself are extremely lucrative in itself. And that is why venture debt does well as a pool of capital. Now, comparing and contrasting all of this to revenue-based financing, this is applicable more for revenue-generating companies where the returns are linked to revenues in itself. The most important part, there is no dilution whatsoever in itself when it comes to revenue-based financing. Now, we always promote the fact that you should combine equity with all sorts of flexible debt options, because when you are combining both of them together, is when you get that explosive mix of capital that allows you to unlock your cash flows better. Now, you are generating your cash flows from your business primarily in the form of revenue, but you will always have your cash flows stuck in inventory, in marketing, in some sort of capex. This is where if you were to apply equity and flexible debt smartly, depending on the pros and cons of each one, you can build a much larger business fairly quickly in itself. Just to give a quick 30-second, 1-minute overview on what revenue-based financing is. It is a fairly simple concept in that revenue-based financing providers like Club give you capital, but they take back returns linked to your revenue on a monthly basis. So on a month-on-month basis, whatever you make as revenue, a pre-agreed percentage of that is taken back as returns. Now, a lot of consumer business specifically, end up having seasonality in their businesses. They have cyclicality, which is coming in from certain macro themes in itself. This is where revenue-based financing ends up being a great option, because during lean months, your returns are lower, but during good months, during months of high revenue, your returns are also higher. So it is absorbing risks on both sides in itself. Now, we fundamentally believe that this option of revenue-based financing needs to be across a spectrum of tenures. Different businesses have different requirements of capital for different time periods in itself, which are called tenures. So we actually start off for something which is as low as 7 days in terms of capital that we provide. And we can provide capital all the way up to 24 months in itself for certain growth use cases as well. We've also done use cases of 36 months as well, but that is more an exception. We prefer to be less than 24 months at any given point in time. The entire risk assessment is driven off by data, and the entire repayments in itself are driven off by technology, making it a simple, no-nonsense way of raising capital for businesses in itself. These are the kind of businesses for which revenue-based financing is ideal. It includes a lot of consumer brands in itself. You, of course, have seen the term D2C come off vogue. We always argue that D2C is not a new term. D2C existed pre-COVID as well. It is just that post-COVID and during COVID, you are seeing this term really scale up at this point in time. And apart from consumer brands, which just include D2C, it also includes online marketplace sellers, where a lot of businesses are utilizing marketplaces like Flipkart, Myntra, Nykaa, Amazon to sell. And so a lot of consumer brands are applicable there as well. Revenue-based financing works very well for the entire F&B and cloud kitchen space as well. It also works very well for capex-heavy businesses. Those are the ones on the consumer side where you would see revenue-based financing. But interestingly, it also works for subscription businesses. Again, because there is a recurrence of revenue in itself that works very, very well. Now, these are the use cases of revenue-based financing, and I want to double-click on this a lot more, because if you were to think about unlocking your cash flows, this is how revenue-based financing can help. Revenue-based financing is ideal for businesses where there is a certain input-output function. What that means is, if you were to be provided input capital, there is a certain predictability of output revenue. That predictability comes in from the use cases of capital. So when you are applying for this input capital for your inventory use cases, for your marketing use cases, for your capex use cases, that's when the power of revenue-based financing is truly, truly unlocked, because you know that the turns that you are making on your business, utilizing that capital, are far more predictable in itself. We generally do not recommend businesses to raise revenue-based financing for salaries, say, for example, for general OPEX in general, or for what we call R&D in itself. We recommend that equity be that use case, be that utilization of a provider of capital that you can utilize for those use cases in itself. Now, ultimately, the way that you would think about your cash flows is you would utilize a combination of equity to fuel growth, but you do not want to burn up that precious equity when you can raise debt on top and utilize that to keep on converting your business in itself. So a lot of smart founders, what they do, and that applies for Klub as well, is that we raise equity, we keep that in the bank, we raise debt on top, on the back of that equity, and we utilize that to keep running our business over and over again. Of course, the equity is utilized as well, but it is utilized for other use cases where the input-output function is not as clear. That allows you to stretch your equity dollar to the longest. That allows you to generate more cash flows from your business in itself, which you can keep plowing back, especially as a consumer business, either in inventory or in marketing in itself. A lot of businesses that we meet also have a duality problem, in that they would either have less inventory at some given point in time because they have spent on marketing, or they have inventory but they don't have marketing dollars left. This gap is what RBF solves for very, very well, and we can utilize that in a very smart way as well. I'll take questions at the end if you're okay with that, because that allows us for a much more engaged discussion. I want to take all of you through some case studies of some businesses that we've worked with in the past who've utilized this strategy a lot more smartly as well. Here are the pros and cons of revenue-based financing that you should be aware of while we always speak about the fact that we are fast, we are flexible, we are non-dilutive in nature, and hence we are founder-friendly. We are fair. We do not care about your city where you're coming from the kind of business in itself, and we are frequent in nature. It's the cons where I want to spend some time because no one speaks about it as much. The first con of revenue-based financing is that it is more expensive than bank debt. It is a fact. It cannot be disputed. We are more expensive than bank debt, which is why we always recommend our companies to raise bank debt. It comes back to haunt you. It comes back to bite you. The number of companies that we have seen that have raised debt in the past and not taken it seriously is surprisingly very, very high. And we keep on calling that out, that ultimately this world is a round place. You have to utilize debt only if you are credit worthy. Otherwise, it doesn't work. Last but not the least, the ROI of revenue-based financing is best when you are having a correlation between the input capital and the output revenue. Whenever there is an uncorrelation between these two is when we see businesses struggling. A lot of businesses end up raising RBF more as a last minute option, as a Hail Mary option, if you will. Hail Marys don't work with revenue-based financing. It is ultimately designed for businesses that are a going concern, need not be a high-growth business, might as well be a flat-line revenue business with predictability. That is fine for revenue-based financing, but you should always be utilizing this slightly expensive form of capital when you have a correlation between your capital and your revenue in itself. Apart from this, I'll just quickly spend a few seconds speaking about what Klub offers to the businesses. Ultimately, while capital is the big requirement for a lot of businesses, they are searching for growth in itself. And there are a lot of ways that we end up working with our partners as well, our partner brands as well. A lot of it is around optimizing their business in itself, for which we work with specific partners that we connect our partner brands to. These partners help our businesses optimize their cash flows a lot better, optimize their revenue a lot better. We have also worked with some of our portfolio brands to be able to help them to raise their next round of equity capital. A lot of it need not necessarily be driven off by a VC fund. These could be rounds driven off by angels or family offices as well. And so we have assisted in that process as well. But more importantly, unfortunately, I cannot speak about this, but there's a very, very promising and very high growth lever that is coming up soon from the Klub stable in itself. These are the ways that we drive not just capital, but growth for our businesses as well. Because when businesses are growing, it actually helps our revenue and, of course, our core product of RBF in itself. Now, with that, let's switch gears into some case studies, because whatever we are speaking about unlocking cash flows, the best way to think about it is understanding what other businesses have done in the past. This is where here are some examples that we can utilize as well. Some of the examples include a coffee shop chain that actually ended up raising capital pre-COVID and then utilized that capital during COVID to keep themselves alive. Revenue dropped off, and so they were paying negligible revenue shares in itself. So revenue-based financing ended up being a great way for them to sustain through the entire downturn of COVID. And then when the market started opening up, they did extremely well and scaled up. Now, the first round of funding was done just before COVID, as you can see. This was one of our first few pilots. But after that, this business has raised multiple crores over subsequent funding rounds through Klub. Now, this is an interesting part that I want to share with you, in that they raised 6.5 crores over 6 rounds. Now, equity capital in itself gives you a pool of money upfront. It sits in your bank account, and you utilize that as and when you need it. Revenue-based financing and debt are slightly different. The meter starts ticking the day you start utilizing this capital, or the day you start taking this capital in itself. Hence, it's very, very important for you to time your revenue-based financing round smartly, because otherwise you will end up paying for those cash flows in itself. Now, the good part is low revenue, so low outcomes. But when it comes to regular EMI-based debt, this ends up being a bit of an impact for businesses, and your cash flows start getting impacted. So you do multiple funding rounds as and when you need the capital, as opposed to doing it in one shot. We've been told over and over again as a media narrative that if you've raised a large equity round, it is phenomenal. It's not true for the debt side. Debt you keep on raising in small bite-sized portions such that you can utilize it efficiently and you can keep repaying it back. There is no value of raising large debt rounds immediately because the meter starts ticking. And that is what this business did very, very smartly. They've now gone on to raise much larger equity rounds as well, and it's a phenomenal business in itself, both online and offline. The next example that I'm going to utilize is for a millennial fashion brand. It's a name that I will not take, but it's a very, very well-known brand. And they needed capital for their marketing spends. And these marketing spends were not just digital marketing spends, it included influencer and celebrity marketing spends as well. At that point in time, they were even thinking of doing a TV commercial, which was ultimately canned, and the capital was utilized for digital marketing. But we can even do it for TV commercials as well, because there is a certain predictability of the revenue growing in itself. Now, over 7 rounds, this business has now raised nearly 17 crores through Klub, and we continue to keep on doing more with them as they keep increasing their sales. Now, please note that this business did go through a bit of a downturn for unforeseen reasons, and that is where revenue-based financing came in very, very handy. When the business was going through a downturn due to some unforeseen circumstances, at that point in time, their outflow towards debt was not high. The other reason why this business ended up raising this capital through Klub is because this was completely non-dilutive in nature. So the reference for this company actually came through the venture capital investor that was sitting on its board. They realized that they needed to provide flexible debt to the business to grow, but in a non-dilutive manner. So they chose revenue-based financing over venture debt, largely because it did not go into those loops of warrants and dilution. And so this ended up being a great partnership between Klub and this millennial fashion brand, where they utilize the capital note for their influencer marketing and digital marketing spends. The next case study is of a leading furniture brand. Now, this is again a slightly different use case, which we want to share and speak about. This business has raised capital, but this is for inventory stock-up. And this inventory stock-up is during the high demand season that they see. And so they keep on raising debt to acquire inventory, to stock up for the inventory, and then they keep giving that out for rentals in itself. So it ends up being a great way for them to have capital that they can directly utilize, and then they can see output revenue coming out of this as well. So inventory ends up being a great reason for businesses to raise capital. We are now entering the festive season, so we will see a lot of businesses being able to unlock their cash flows, largely by applying it for inventory smartly. So for inventory, if you are applying your equity capital, you're utilizing your equity capital only for a single turn. Please note, once you have burned that equity money for inventory, it's gone. It's not coming back. On the side of debt, you can keep utilizing debt to build more and more inventory turns, if you will, and that allows a different way to construct your equity and your debt solutions in itself. The next use case is more about an electronic seller. This is one of India's leading electronics provider. They are very, very focused on the gaming segment in itself. Now, they use debt capital very smartly only for the festive season. They see that during the entire Amazon sales, Flipkart sales, and especially during the Diwali phase, their business goes through a spike and they have to order their inventory from China and from local manufacturers in advance. So they actually raise shorter tenor RBF through Club, and then they utilize that to generate good inventory sales during the festive season. But during the lean period, which comes in around the December to February, March time period, they do not raise any other capital in itself. And so RBF ends up being a great way for them to construct shorter inventory turns in itself, aimed just for the festive season. Now, this business has done so well that they recently got acquired as well. And actually, I will not say acquired. They ended up getting an equity investment as well. And so this business just utilized this very smartly to literally double their business within a year's time in itself. A last case study, and we'll pause right here after this, is that there is this example of a gourmet chocolate brand which had a combination of online and offline presence. They utilized capital for capex expansion. They utilized their capital, the RBF capital, for inventory stock up, especially during the October, November, December phase. And they also utilized RBF for their marketing capital, again for the OND phase. Now, what you would see is there is a fair bit of stock up that happened during the pre-festive season, which is the June, July, August phase. That is when they actually took on a lot of debt capital, and that was all during the October, November, December phase. During October, November, December, they only raised capital as needed for marketing pushes because they were seeing that this is something where the business could turn a lot better. When January, February, March came in, they actually utilized that for store expansion. They utilized RBF for store expansion, which is more longer term in nature in itself. Now, this business, the interesting part is they utilized flexible debt till they reached maturity for an equity round. So they did not preempt the market and reach the market earlier, the equity market earlier. They were turned down multiple times by equity investors. They utilized that 1 year through RBF. They built the business to a level where they got their Series A funding in itself. Now, this particular brand has raised nearly 15 crores over 15 investment rounds as well. So if you were to think about this, there are multiple rounds that this business has done over and over and over again. It continues to repay the capital back and keep on utilizing it very, very smartly. These are ways that you can utilize RBF to unlock your cash flows, because ultimately, if you were to think about a better, smarter utilization of capital, it can go a long way in stretching that equity dollar, and it can go a long way in unlocking your cash flows such that you are not logged either on inventory or on marketing, especially during this festive season in itself. I'll take the last 2 minutes to just speak about the equity funding winter as well. This is, think of it as a bonus slide in itself, no correlation in itself. But a lot of businesses are now going to see equity markets slow down. And that is why we are recommending that here are some strategies that you can utilize during this funding winter. The first is utilize traditional and alternate funding options. We cannot stress this enough. The number of businesses that have now reached out to Club have grown nearly 4 or 5 times. We are now even working with unicorns as we speak. There is no reason why your business should not be exploring alternative funding options. You should do that regardless of your size and stage. The second thing, we're borrowing this from the book from Ben Horowitz, is that this is absolutely wartime for a lot of businesses out there. You have to get into very, very tight planning and execution. What you hear about in the business in the market is cost cutting. The answer is it's not just about cost cutting. It is so much about better planning and very, very tight execution. A lot of great businesses are built on the back of solid execution. And if you get that recipe right, if you are able to plan your business effectively, apart from cutting that you will implement during this war phase, it can lead your business into a new phase of growth in itself. The third is that you need to utilize smart partnerships, smart strategic partnerships to reduce your CAC. There is a session going on in parallel on the meta side about how to think about CAC. While you will utilize digital marketing in itself, how do you think about partnerships to reduce your CAC? That is a strategy that we don't see a lot of consumer businesses think about. But if you were to think about it smartly, we've seen CACs nearly half, nearly become zero for a lot of businesses as well for that particular cohort in itself. Last but not the least, something that is not spoken about is how do you extract more and more revenue from your customer. That goes a lot into product experience, customer experience as well. During war phases, it's absolutely thrown off in a corner. But actually, if you bring that back in vogue, if you delight your customer, you might be able to extract that extra dollar, which can help you raise more revenue as well. With that, thank you so much for hearing us through with regards to revenue-based financing, with regards to thinking about cash flows through different use cases that businesses have seen in the past, and last but not the least about Klub as well. I'll stop presenting here and we'll open this up for questions from here. There were a few raised hands in itself, so I am now accepting them as well.
Hey Anurakt, so the question is, does Klub provide RBF to traditional companies, for example, manufacturing?
Yeah, I think it's an important question in itself, something that we keep hearing about over and over again. So let me take that head on. Manufacturing businesses have traditionally not been in scope for revenue-based financing in a lot of countries. RBF players are ultimately looking at predictability of revenue, and manufacturing businesses in themselves tend to be more lumpy in nature, if you will, in that you put up a manufacturing unit and then there is a certain predictability, there's a certain revenue output that comes. What we have seen is that the kind of manufacturing businesses which are more traditional that end up coming in vogue are the ones where there is still some sort of an ongoing revenue stream that is coming out. And by adding more and more units, by adding more and more capacity, you can actually see that there is more stickiness that is built in. A lot of manufacturing side businesses that we tend to look at need to have stickiness with regards to their customer base as well. If it's more of what we call on-off businesses, where there isn't enough revenue predictability from your customer base, then it becomes very, very hard to look at the manufacturing sector and the traditional sort of sectors in itself. Now, with that, we have looked at a lot of companies. We have deployed capital in a lot of companies that are what one would call traditional in nature. The traditional nature of the business does not matter. It's the stickiness of that customer. It's the stickiness of that revenue that ends up mattering more. Probably what we would recommend is give it a shot. How does it hurt? You're already reaching out to banks at this point in time, is my guess, for raising capital. You're trying equity sources. Why not give SME financing and revenue-based financing a shot as well? There's nothing to lose. It's a very fast turnaround process where people give you decisions fairly quickly, and it might just be a good way. It might just be a boost in the arm for you.
Anurakt, the next question is, how does RBF work for investors? And also, if you could highlight how payback of capital happens for companies. Is it similar to debt?
Got it. So there are two parts of the questions. If I understood the question, one is how does it work for investors? The second question is payback of capital and how does that work? So let me explain that as well. Now, on the investor side, there are different kinds of investors that are there on the Klub platform. In fact, that is the unique part about Klub. We are the only revenue-based financing company in the world that has nearly 15 sources of capital on our platform. Each pool of capital has its own requirements. It has its own structural limitations, regulatory guidelines. It has its own requirements with regards to risk return outputs in itself. And so what investors can get through the platform are, depending on what category of investor is, an above market return, especially at a higher frequency in itself. When we work with NBFCs, say for example, there is a different risk return profile that we can work on. And when we work with HNIs, family offices who also want to deploy flexible debt capital through the club platform, it ends up being a slightly different use case. In either of those use cases, along with the fund setup that we have, ultimately the revenue share is repaid back to the investors on a monthly basis, and that ends up being the way that they generate returns. Each company has its own risk return profile, and so we're not trying to say that different kinds of risks are the same for companies. It's never the case. Different kinds of companies have different risk profiles at different points in time, and so we are optimizing for that risk and a return associated for that risk, which the investors are then able to understand and absorb. Let me speak about the second part of the question, which is payback of capital. The typical payback of capital varies by the tenor in itself, but I will take absolute simplicity at this point in time. For a business, if say, for example, we give you 100 rupees for a period of 12 months, we expect 115 to be paid back over the 12-month time horizon. We agree on a revenue share, say, for example, 5%. So 5% of your revenue keeps coming back up until 115 rupees is collected from your business in itself over that 12-month time period. If in case there is a revenue over performance, then there is a cap in place so that you don't end up overpaying. At the same point in time, we have seen that some businesses prefer floors as well, in that there is a certain minimum that they keep on servicing such that they don't have to end up paying a lot during a low year, if you will, to in the last month in itself. So there's a fair bit of flexibility that we have constructed. Now, all the numbers that I gave you, 12 months, 15, 115, or rather 15% yield, all of them are representative in nature. They keep varying by the use case. As mentioned earlier, we can do something as low as 7 days, can go all the way up to 2 years as well.
Hi Anurakt, can you hear me?
Yes, I can, Harshvardhan.
Hi. So thank you so much for your time. Firstly, this was really insightful as I run a cloud kitchen company myself based out of Mumbai. So we just focus on the modern Indian food panel. So we're not into multiple outlets or multiple different cuisines of food. We just run one that's modern Indian. We're one of the only delivery chains in Mumbai for that. We're looking to raise rounds, and of course, when you shed some point for the funding winter right now, we're definitely facing that because a lot of the shift has gone from food towards the technology side as well. How good of an option do you think RBF is, and what is the potential? I'm assuming that you do know the background of how a cloud kitchen would operate over here, considering that the entire market is dependent on Zomato and Swiggy. These guys take a hefty amount from us. The food costing comes into play. So just wanted to get some sort of a feedback or understand more on this from you.
Absolutely. So, in fact, cloud kitchens end up being one of the larger categories for revenue-based financing. Nearly a third of our portfolio is made up of cloud kitchens and F&B brands. Two examples right here were cloud kitchens in the case studies in itself. And so a lot of businesses have utilized RBF very, very smartly to scale up their businesses. Now, typically what ends up happening is we see 2 or 3 use cases again. The first is ongoing operations of your cloud kitchen. We generally don't recommend that as much up until you are doing some marketing. But the bigger use case that we've seen is expansion. So whenever you're setting up a new outlet, you need capex for that. And that is where RBF has turned out to be fairly useful for some of these businesses as well. Now, ideally, Zomato and Swiggy, yes, one can keep on arguing that they end up charging higher or lower. That debate is ad infinitum in itself. But for whatever it's worth, you can actually utilize your Zomato, Swiggy, and your own direct sales that are happening to be able to repay this debt at a higher frequency such that you're not strapping your cash flows. What we see a lot of businesses do is they wait for the end of the quarter or the end of the month to repay back. And yours is a dynamic business. So when capital or the revenue share gets collected at a high frequency, pretty much on a daily basis, your business does not see that impact at the end of the month. We've done a lot of cloud kitchens, starting from very small cloud kitchens to large cloud kitchens. Typically, we recommend that if you're doing revenue less than 5 lakhs per month, Probably you're a bit early for revenue-based financing because you do need some predictability associated. But if you've surpassed that threshold, then you should absolutely explore revenue-based financing and cloud.
Can I just ask another question? So sorry.
Please go for it.
But yeah, so definitely I do get that, and that was sort of the benchmark we did set before we wanted to go in and kind of sort of raise the funds. We do have a very good recall value for our brand in terms of the revenue benchmark. Also, we're doing very well on those lines as well. However, it's really difficult to sort of network and connect. For me as a personal problem, it's been like, you reach out to any sort of company or any person. It's very difficult to get it out to them and sort of communicate, which is why I'm really glad to be a part of this platform right now to sort of even speak and interact with you and have sort of a discussion regarding this. For me, have you also dealt with cloud kitchens with just single operations? So like a lot of cloud kitchens, they're in the food tech cloud kitchen space. So these guys run multiple brands from one kitchen. However, we run one single brand because we've understood the value of having a niche and expanding that. So definitely the funds are going to be required for expansion because we did crack something where economies of scale is the only way to make a cloud kitchen profitable. It's just that one outlet will not suffice, two will not suffice, three will not suffice. Just wanted to understand, like, I feel like RBF is the only option today. So do you think that that's something that's the only thing we should target looking at the winter equity thing right now? Because we and many cloud kitchens along with me, we're at a stage right now where they're not getting funding rounds today. We're not getting any money from people today. Okay. So is RBF a good option? Is this something that we should look towards specifically? Because of the entire metrics of how cloud kitchen works, the money is definitely required for capex and working capital. So for expansion and your working capital. So do you think RBF is what we should be looking at just specifically for this industry today?
Absolutely. So I'll give you sort of simple answers and then more complicated layers on top. The simple answer is yes, you should absolutely look at revenue-based financing. But no, you should not look at revenue-based financing only. See, you are a founder. You have to go build your business. So you will tap into all avenues of capital as is possible out there. There is no ideal answer that is going to be ever present, omnipresent for you as you scale and build your business. So you have to keep pounding the pavements, looking at different options in itself. Now, you mentioned that networking is hard. You mentioned that it is hard to raise equity capital, and we completely echo that sentiment, which is why, at least when it comes to revenue-based financing, the entire decision is driven on the back of data. We don't even need a pitch deck. We don't need to pitch. We don't need you to pitch. We don't need to speak with you. All we need to understand is your data, because if we can understand your data, we can go ahead and deploy capital within literally a couple of days, max to max 3 to 4 days in itself. That's the way RBF is designed. But please, please, please don't depend on a single source of capital. Continue to evaluate all sorts of options. If you are to build and scale your business, you will not be able to focus on only a single segment. Yes, we are going through an equity funding winter. And so debt is what one would call a slightly good option. But you don't want to just look at debt only because there's an equity funding winter. You have to look at it all of the times.
Right. Okay, thank you so much.